Hello and welcome to the 36th episode of Consumption Radio. My name is Subodh Pandit and I am the director at Econometrics Research. Today is the 1st of June 2026 and I'm titling today's episode The Market for Lemons and the case of asymmetric information and institutional capture. And this title draws inspiration from another paper, which is by the same title, which is by George Akerlof, and this is a Nobel Prize winning paper that was written in the context of used cars. And I believe that there are similarities to the situation of asymmetric information in the context of used cars to what we are witnessing in the capital markets these days. Not just the capital markets. I believe most of the markets in the economy are affected by this problem, which is this used car problem, wherein we are observing a certain information asymmetry between the buyers and the sellers. And as the paper suggests, eventually this situation leads to a market failure. And the only thing that I would like to add to the conditions of an information asymmetry is the fact that the current conditions in the market are also characterized by an institutional capture, which is somehow covering up the market failure. And what we are observing basically is the fact that there is an information asymmetry between the buyers and the sellers. And the buyers, however, are compelled to buy, even though they are probably buying a piece of a useless asset or a very highly priced asset. They have no way out because of the fact that there is an institutional capture. So, in that sense, this situation that is existing in the markets today is unique because we are having asymmetric information, but that is coupled with an institutional capture, which compels the buyers to buy at artificially high prices. And this is the characteristic that is existing today in the case of capital markets. And for example, when mutual funds are buying on behalf of retail investors, the retail investors don't really have a say in terms of how the mutual funds buy and under what terms and conditions do mutual funds buy. And it is up to the mutual fund insiders as to what prices they will be buying the assets in the stock markets. And the retail investors do not really have a say whether uh, they should or should not, the mutual fund managers should or should not be buying at particular prices in the stock markets. So there is an institutional capture by these institutions, which includes mutual funds, which includes the regulators, which includes the merchant bankers, and they all of them collude to basically force the buyer into buying lemons and lemons at very very high prices. And that is the Ponzi scheme that is running in capital markets and other markets as well. For example, in the case of real estate markets, too, we are having an institutional capture, and which keeps the prices elevated artificially to very high levels, and the buyer is compelled, arm twisted, to buy at those high prices. And so, therefore, we have this case of a market for lemons, wherein relatively uh, troublesome, useless assets are being sold at artificially high prices because information asymmetry in favor of institutions, colluding institutions, is is combined with the institutional capture, and what we end up with is a certain Ponzi scheme wherein assets are exchanging hands at artificially high prices. And of course, eventually, this is also going to lead to ultimately a market failure. And we are going to observe the fact that there is going to be this realization that the holders of these assets are in fact holding unproductive assets, and eventually there will be a collapse of the artificially elevated prices of these assets, and those people have who have been thinking that they have fooled the buyers into buying assets at artificially high prices will also have to pay the price, because ultimately those people who have captured the institutions have also then converted their wealth into equally illiquid assets, and they will also be faced with with the same consequences as the retail investors who have been fooled. So it doesn't matter whether these people, which are the merchant bankers, which are the mutual fund insiders, which are the regulators who have siphoned off the money to a safe haven like Singapore or Dubai or any other place. Eventually, the illiquidity of the assets that have been acquired by siphoning off the funds will also imply that the prices of the assets that have been acquired using these ill-gotten means will also collapse, and that's the condition that we are looking at uh, in the current context in India and also globally. Globally, as far as, for example, the overselling of the AI story is concerned and the hype is concerned, which we have forecast is going to fall flat on its face in June and July, which was this month and next month. And we've also pointed out in our earlier episodes that how there is virtually a bonfire of retail money that has been lit in the stock markets via these domestic institutions. Essentially, retail money has been put on fire, and which is also now increasingly coming to light. And over the next 2 months, we are going to be faced with those consequences. We are not giving any buying or selling recommendations, but these are just our general opinions and predictions regarding the overall state of the economy and the state of the markets. And we believe that we are moving towards market failure because ultimately we are having a market for lemons that has been existing in the stock markets, in the real estate markets, and uh, this market has been suffering from information asymmetry. But additionally, there's something that Akerlof's paper probably did not emphasize is the fact that now we're also looking at an institutional capture. So information asymmetry coupled with institutional capture ultimately is leading to this market failure that we forecast is going to be observed in June and July 2026, and be it AI or be it any other Ponzi scheme that is being run through trapping unsuspecting retail investors via pension funds or mutual funds in India or abroad. The weaknesses of the system are coming to light, and both the perpetrators of this system, which is the insiders, who have hoped that they will be able to fool all the people all the time, and also, of course, the retail investors, which stand to lose a lot of their hard-earned money. Both of them are going to be faced with the consequences of market failure in June and July 2026. So this is, in a nutshell, what I wanted to communicate about our previous forecasts and the context in which we believe the hypothesis that we believe will be behind the collapse of that we are going to be observing in the case of capital markets, be it the overvalued AI stocks or various other stocks which have come through IPOs, and basically the merchant bankers have been instrumental in selling these lemons to unsuspecting retail investors, and mutual funds have played their role in buying uh, uh, those overvalued stocks and providing an exit to the so-called FIIs in the context of India. We believe that, again, these are not buying or selling recommendations, but this is simply an observation that we are headed for a market failure, because ultimately what has happened is, because of the institutional capture, we are looking at a market of useless assets or a market for lemons, and ultimately everybody is going to be left holding the bag, and probably 90% of the population in India, at least, who are not probably seriously invested in the stock markets, are still going to be protected, and protected in the sense that they're already living on the fringes, and they're already living on a subsistence, hand to mouth kind of an existence that they're having, and the only basis of the existence of the 90% of the population is their mutual goodwill, and their ability to basically fight every day for their struggle for survival, daily survival, and they are not going to be affected because of the fact they're already struggling anyway. And what we are going to observe is that as we move up the income ladder, and we look into essentially that part of the population that is more and more a part of the formal financial system, that part of the population is going to be increasingly or largely going to be affected by the coming collapse, or the market failure that is going to happen in the case of AI stocks and various other capital market securities, because of the fact that we are largely looking at an overvalued uh, 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 overvalued set of assets, be it in the case of the real estate market or the capital markets. And the reasons behind that are also going to be increasingly apparent, as we've pointed out earlier. We are going to observe the strength of the balance sheets of these companies getting exposed, and uh, we are going to observe whether the, uh, uh, the reliability of the numbers that the corporates have been divulging, and are they as reliable as the 6.9% GDP growth of of India, and how convinced are we of the the GDP growth rates, official GDP growth rate statistics, also determines uh, how convinced we will be of the numbers that are published by the corporates, and increasingly the lemons are going to be exposed, and we are going to observe the fact that we are largely having a Ponzi scheme that has been run where overvalued assets have been sold to unsuspecting retail investors via a collusion of the various financial institutions and regulators. And this is what is going to be observed or witnessed in India and also globally over these 2 months, which is June and July 2026. And that's what we are looking at right now. And coupled with all the other predictions that we made, which is the migration crisis and all the other related developments that are going to be taking place, eventually leading to shift away from the dollar, and India also recognizing the shift away from the dollar to the Iranian benchmark by December of this year. So that's our podcast for today. Our first half of June 2026 forecast of India consumption aspirations is available on sale, and we also have an optional payments link for our podcasts. And hopefully, our podcasts have been adding value to the institutions who've been listening to them, and hopefully, they will come forward and make use of the optional payments link that has been provided with the podcast. So that's the podcast for today. Goodbye.